Okay, good evening, everybody, and good morning to our remote audience, some of whom I know are joining live from Asia. So I'm Lucy Allard, and I'm the director of the Center for Global Management, which is the center organizing this evening's discussion. So for today's conversation, we're delighted to welcome UCLA alumnus Craig Ehrlich, who served as chair of the Center for Global Management for 7 years and past chair of the UCLA Foundation. Craig will moderate tonight's conversation with Justin Barton, President and Chief Investment Officer of the UCLA Investment Company, who is responsible for the management of UCLA Foundation's approximately $4 billion endowment fund, a global multi-asset portfolio. Along with UCLA Investment Company team, Justin oversees all aspects of the endowment, including executing investment strategy, portfolio construction, and governance. Craig will introduce Justin in more detail. So tonight's discussion is part of the Center for Global Management's World Today discussion series that engages the audience in dialogue around current issues that transcend borders with thought leaders who share their perspectives on topics that are of significance to the community and the world. This evening's discussion is actually a follow-on from the conversation that Craig and Justin had as part of the Center's special COVID-19 discussion series back in April 2020, right at the beginning of the pandemic. At that time, they discussed the key issues faced by institutional investors amid COVID-19 volatility as they and other private fund investors were considering the economic exposure to their investments from operational disruptions as a result of the pandemic. Now, 4 years on, in a post-pandemic world with great macro and market volatility, several new challenges to investment are emerging. Amid technological change, global production shifts and geopolitical fragmentation, as well as ESG and sustainability regulations and conflicts around the world, investors are really rethinking their asset allocation and once again considering the global economic exposure of their investments. Today's conversation will focus on navigating today's complex investment environment and how investment models and strategies have evolved since the pandemic and will need to continue to evolve. Craig is the perfect moderator for this particular conversation, as in 2015, he became a member of the UCLA Foundation board and was then elected chair of the UCLA Foundation in July 2020, during the height of the pandemic. He's founded numerous companies and served on numerous boards. And today, Craig remains a very active and engaged member of both the Center for Global Management Board as well as the UCLA Foundation Board, and currently serves as chair of the Luskin Orthopedic Institute for Children in alliance with UCLA Health. So we thank Craig for his unwavering support and his many contributions to the UCLA community. And please join me in welcoming Craig Ehrlich and our distinguished guest here this evening, Justin Barton. Thank you.
Thank you, Lucy. For those who have not had the pleasure to meet Lucy, Lucy is what keeps the Center for Global Management active. She has been a passionate leader in making sure that CGM has a great impact on Anderson. So we thank Lucy for all that she does. I also want to, before I introduce Justin, I want to thank one other person for inspiring this conversation, and I'm sure he is online in Hong Kong. I want to thank Martin Matsui, who was a longtime senior leader at the HKMA Monetary Authority in Hong Kong and has been a big supporter of Anderson, and it was his provoking us to do something and have this conversation that we held 4 years ago, now that the pandemic is behind us. So Martin, thank you for inspiring us to have this conversation. It's a pleasure to introduce Justin. Justin Barton is an amazing leader. He is responsible for something that is key to UCLA. As most of you know, an endowment for any major university plays an important role in funding many of the programs, many of the faculties. So Justin and his team have a very important job. As Lucy indicated, he holds the title of President and CIO of the UCLA Investment Company. He started his career at Brown University He has had professional stops in New York and in London. I will highlight the fact that Justin has a very global background. He has degrees from Princeton and a graduate degree from the University of Cape Town. So he is someone who is very keen on global issues, and we'll get into that in a moment. Justin, I think as we start this conversation, I would imagine a lot of the audience does not actually understand what the UCLA Investment Company is. Could you take us kind of through an introduction to it, and then I may follow up with some specifics.
Thanks, absolutely. And thank you, Craig, for that introduction. I'm going to maybe bring you along for all the intros I have to do. That was great. And thanks to everyone for having me here. I think maybe starting at what the investment company is helpful in looking at the models that different institutions have taken. Some have kind of staff that are part of the university. Some have created separate investment companies, which is what we are. So our investment company was set up a little over a decade ago as the pool of assets for UCLA got to a size that really merited having a separate company manage that pool with its own governance structure. Prior to that, it really had been a board-driven, consultant-led strategy where board is meeting on a quarterly basis. It's hard to really kind of do that and your kind of day job. And so recognizing that institutional investment management really is a full-time job, creating a staff structure to then make investment decisions and kind of shepherd a process through from start to finish with reporting to a board. Just to give a context of what that means in terms of size, 20 years ago, UCLA's endowed pool was about $400 million, so it's now $4 billion. And when the decision was made to create a separate investment company, it was about $1.5 billion or so. Today, we have 15 people in our office. There's 9 of us on the professional investment side, and then we have operations professionals handling cash movements and accounting and other issues. So that's kind of the structure. As I think Lucy mentioned, we are a global portfolio, a multi-asset class portfolio. So, for those of you who are maybe a little bit less familiar with institutional investment business, you can think of us as very similar in function to a fund of funds.
Can you explain the difference between a university endowment and a pension fund? What are some of the fundamental differences? Because I think most people are not familiar with university funds.
Yeah. I think, from the outside, I think we can all look sort of the same in terms of, that's an investment pool, an investment office. But really when you start looking at some of the nuanced differences between different institutional pools, like a pension fund, even like a foundation versus an endowment, there's a few things that I think are critical differentiators. One of, I think, just from a very high level, we look at and invest what we call the endowed pool, but that really is 4,000 separate gifts by donors, often for specific purposes. So to Craig's comment earlier, it might be supporting a chair, it might be a scholarship, it could be something with so it's always a specific purpose, and each of those donated gifts is expected to exist in perpetuity and maintain its purchasing power, which is a different objective than a pension or even a foundation, right? Foundations aren't expected to exist forever and can spend down their principal. So I often one of my pet peeves in this industry is when I see kind of news reports or commentators talking about universities, quote unquote, hoarding these assets in an endowment structure. They're not, and indeed, they they should be growing in nominal value if they are doing their job of maintaining the purchasing power of that gift in perpetuity if you're living in any sort of inflationary environment. So these pools of capital should be growing in nominal terms all the time. And so those are some of the kind of high-level differences. What that means from a practical standpoint is we have a perpetual time horizon. So unlike a pension that may have a very long time horizon, there is an end to it. We also have constant gift flows, which is different from a foundation. And we have a very high hurdle rate. So if you think of it as we're going to pay out 5% of our capital typically, but need to maintain a purchasing power in real terms, you're talking about, let's say on average, let's call it an 8% nominal rate of return. Because all of you are probably aware that should mean you're going to have a very big equity bias. And so you've got to think through what are the ways to manage that equity risk from both a liquidity standpoint and a volatility standpoint, because you're going to be paying out capital over that time as well. So it's not just point A to point Z, but there are infinite number of points in between that time.
Let me ask one further question in this introductory part. Again, I think most people don't understand, you have this separate management group. What's the governance structure? I mean,
Sure.
Who actually are your bosses with all this money that comes from donors?
Yeah, I mean, I think of us as having multiple stakeholders, and I think that's a really important thing for us to remember in the investment office. So within the investment company, the way we're structured is to get a little bit technical, I guess a 501c3, so a nonprofit, with our own governance board. So we have a board of directors who we sort of report to on a quarterly basis. Now, within that, we're an investment management company with a single client, which is the UCLA Foundation. We manage the UCLA Foundation's assets. So I think of us as really also reporting to, and we do on a quarterly basis also report to the UCLA Foundation board. And then, ultimately the foundation's existence is to benefit this campus and UCLA. So you then also sort of have the administration and all of you sitting in this room as well as kind of our stakeholders. But ultimately, the structure is you've got an investment company board and a foundation board. And the foundation board also has, I would say the administration is represented on that foundation board as well. So that's kind of the structure of it.
Okay, so that's the introduction of the investment company. What is the most important thing that you and your team are dealing with today?
Yeah.
Is it asset allocation? Is it cash flows? What is it?
Yeah, I mean, I think you kind of know what my answer is going to be, and it is and always is. Asset allocation is the primary focal point for us, and it's what we would say to our board as the most important thing we can do to get right, which is framed by our investment policy statement. And that's really shaped by, okay, what are your objectives as an institution? And how do you achieve those objectives in the most reasonable, risk-adjusted manner? Your asset allocation, so let's call it, one of the things that stands out for me in my entire career was a statement from, I used to work at a relatively large asset management firm, a South African firm originally, but also based in London. And the CEO, probably 15 years ago, said to the whole group, never underestimate the power of beta. You're focused on creating alpha, but betas are really important. And that really is, I think, the hallmark of asset allocation. So you have different types of betas, from a market for a different asset class. Those are going to be big drivers of your overall return, and making sure you have the right types of exposures, public equity, private equity, venture capital, natural resources, real estate, for different environments. I was struck listening to Lucy talking about, we did this, I guess, 4 years ago in the midst of a pandemic. And Craig has heard me say this before as well. one of the things that's really important for us sitting in the investment company and for our stakeholders listening to our report backs is what is our time horizon and what are we thinking about? Because 4 years ago, that seems like a long time ago, but UCLA is a 100-year-old institution. It's going to be around hopefully for hundreds of more years. It's lived through world wars, recessions, growth periods, financial crises, pandemics, and over the next 100+ years, it's going to go through that as well. So trying to make these short-term decisions we don't really want to do. We want to be cognizant of what kind of decisions are we making for our sake with 5 or 10-year time horizons, but really it's 20+ year views on what we want to do.
Take us through your current asset allocation, and secondarily, if you could, take us through, since the pandemic, what changes have been made in that asset allocation?
Sure. So the pandemic kind of hit us mid moves in what we wanted to do structurally in our asset allocation, and in some ways, be careful how I say this. In some ways, almost perversely accelerated, got us to a point we wanted to be faster than we would have expected to be. And what do I mean by that? Every investor should be looking at, what are their comparative advantages? You might say competitive advantages, but comparative advantages. For an institution like us, that's going to be our time horizon. And so we can benefit to an extent that an individual investor and even some institutional investors can't benefit from is an illiquidity, let's call it premium, because we're investing a pool of capital that'll be around for hundreds of years. So we didn't really have, I think, the amount that we could have in privates. Those take a long time to build up. And when you see what has often been referred to now as a denominator effect, in the last couple of years, you have public markets coming down significantly, privates not being marked down, and so you have a lot of institutional investors have gotten out of whack in their asset allocation in privates relative to marketable or liquid securities, and that can create some challenges in terms of managing your liquidity. For us, it helped us get closer to where we wanted to be. So ideally, today, we have about 40% in stocks. We have about 13 or 14% in kind of liquid, what we call independent return. So think of that as hedge funds and credit type funds. 12, 13% in private equity, 8% in venture capital, and then about 15% in real assets, and the rest in cash. Where I think we should be is around a third of our assets in stocks, around 20% in independent return, about, a third to a half of that in private vehicles within that, about a third in private equity and venture capital. So call it 2/3 in equity, and then about 10 to 15% in real assets and the rest in cash. So we're kind of moving there.
It takes a long time to move your asset allocation. Talk us through that exercise. Okay, yeah. The board makes a decision. You generate some of the ideas, but the board ultimately says, okay, you need to change the asset allocation. Yeah. How do you deal with that? How did you deal with that over the last few years specifically?
Sure. So that, again, that comes back to the investment policy statement. So you always work and operate in that framework. It's a discussion between our staff and our board and stakeholders. Again, coming back to what are your objectives and how do you achieve those objectives? So it is an exercise in looking at what are expected, and these are always challenging, and especially when you think about what the standard deviation of a return is. So you've got an expected return, let's argue, in the stock market of 8%. And you say, well, that's great. That's all we need to do. You got a standard deviation of returns of 16, 17%. So, 95% of your returns are going to sit somewhere between plus 35 and, minus 20%. So, that's a pretty wide standard of error. So you want to have some mix of correlation between those assets and a sense of, kind of what do you think you can achieve in each of these assets. And then considerations around liquidity and your ability to, and how the different, private and public markets might work. So, if we were to commit, and we do tend to commit around $300 million a year to private markets, that doesn't mean that $300 million is getting invested over the next 6 months. It's actually going to take 3 or 4 years for all of that capital to get drawn down. So you've got to kind of figure out how you're timing it, what your cash flows are likely to be through time, to get a sense of roughly where you think your allocation will be and what liquidity might look like for your pool 3, 4, 5 years from now.
Liquidity is also, in a sense, peculiar to a university endowment, isn't it? Because the university's budget, any university, it's an annual budget, obviously, and they are looking for certain funds that, in our case, as a state university, that the state legislature is not giving us, that the fees the students provide, that's not providing enough. So the university is very dependent on a certain flow. So take us through the liquidity issue just related to paying to the university.
Yeah, so that's where I was getting to on the comment about, in some ways you might think volatility doesn't matter because you just want to generate a high return for this capital. But ultimately, if you are pulling capital out on a regular basis, and really if you want, for a university, what do you want more than anything else? You kind of want budgetary stability, right? Unlike a traditional grant-making organization, which may like to say that they want to commit the same amount. If there's fluctuation, you're just making a charitable gift, but you're not funding the operations of your institution maybe to the same extent that a university is. Being able to smooth out that payment and figure out what is a sustainable rate to make while being able to continue to generate the returns you need to do is the exercise we kind of operate on. So that's an annual process with the foundation to sort of set a spending rate, which tends to be about somewhere between 4 and 5% is kind of what you think of as your kind of your removal rate of capital, and that gets smoothed over over a trailing period of time to try and make sure that you're creating a sustainable rate to pay out.
So, for example, in this past year, I'm sure this is public information, how much money did UCLA get from the investment company, approximately?
Yeah, it's probably in total somewhere around 200 million or so in kind of contributions out.
So you imagine UCLA not having that 200 million. That would have a big impact on it.
Yeah, and particularly when we talk about when I mentioned earlier those 4,000 different gifts, there's a different reliance, let's say, and I'll just pull randomly, like an anthropology department that may not have as much coming in on a regular basis as, say, the healthcare system. And so that payout that you receive, or for a specific scholarship, or for a chair, is a very meaningful part of the overall budget. So you have different dependencies within that, let's say, 4,000 different gifts.
Let's move into a more interesting area in the sense of maybe people can relate to this, and no matter what you guys are thinking about in terms of career moves, geopolitics. Take us through, as the CIO of a large pot of money, how does geopolitics impact your decisions, short, medium, and long term?
Sure. So maybe to level set where we are today in terms of geographic exposure for the endowment, it's probably about 60% in the US of the total pool, probably 15 to 18% in Europe, about 7% in China, about 4% in India, and the rest is kind of rest of world. And a lot of the changes there in the last 3 or 4 years are more a function of market moves than active decisions on us to kind of, let's say, remove capital from certain areas, although that is something that we're kind of always evaluating and looking at. So, I would say our Asia exposure probably peaked around 4 years ago at probably somewhere around 25% of the endowment. It's today, probably 12 or 13%.
And that was primarily driven by China?
It's primarily driven by the weakness in the Chinese equity markets over the last 3 years.
Right. And take us through your approach or your thoughts on China and India, if you don't mind. Because I know you and I have talked about China and India over the last 5 years quite a bit.
Yeah, and I, just for context for everyone here, before I came back into the endowment world, I spent about 10 years as an emerging markets investor. And so it was, kind of a long history across all these markets, and particularly China and India. I think we, along with many investors like us, went to, have gone to a lot of these markets and emerging markets on probably a two-pronged belief. One is you have less efficient markets, and so there should theoretically be more alpha available there, which I would say empirically we have seen. So fortunately, the managers that we have partnered with have been able to generate significant amounts of alpha in these markets, certainly relative to the competitive space that you see in the US in terms of let's call it the absolute value of alpha. There's a great book written by Michael Malbison, kind of called The Success Equation, that I would recommend in terms of looking at some of these factors, like distinguishing between skill and luck. So looking for, let's call it, less skilled games, less competitive games. But the second piece I think people were kind of thinking about was, if you have higher growth, economic growth, there's less kind of empirical link to returns for markets. But if you have stronger growth, companies that are growing more quickly, I think the expectation was maybe that the beta of some of these markets would be better. And I think that's been certainly, when you look over a 10-year period, that's certainly been challenged relative to the US. The beta in the US has been better. And I think in the last few years, there's just been concerns around, what minority equity ownership means in markets like China, what some of the, let's call it, challenges structurally in a market like India, where you have a handful of companies that dominate the public markets. So what does that mean for competition for smaller firms coming up? I think those are all questions that have kind of entered into a lot of institutional investors' minds over the last few years.
How do you make these decisions? Take us through who literally makes these decisions within your group, and how they actually come to a recommendation to you and then to the board.
So, the investment professionals in our office have, decades of experience, not in the way that I sort of, as a pet peeve of mine when I see presentations that tout, we have a combined 100 years of experience, but each of our senior people have, I would say, decades of investment experience. So there's an element of knowledge of these markets and these groups that we are partnered with. That's a starting point. We have certain heuristics of what we're looking for in terms of the types of managers that we want to partner with.
Explain that to everybody about managers, as opposed to, some people may think that your team is going out and picking to buy Google stock or China Mobile in China or
So as I said at the outset, we're kind of structured more like a fund of funds. So the investments we make are into partner vehicles, whether they're private drawdown vehicles or hedge funds or long only equity funds. But there's always a specialist firm, typically a boutique firm, that is managing that investment pool, specific sort of subset. What do we look for typically? I'd say, a good example would be a single product firm, owner operated, in a niche part of their market, often in a concentrated portfolio. Think 5 to 15 holdings, where we think that that team can really know and understand what it is that they're investing in, and that we can also diligence and understand. I would say we play sort of a dual role of both, you can call it forensic accountant and psychologist, in terms of understanding what are the motivations of these people that we're entrusting millions of the university's dollars with. So why do they do what they do? Those are the things that we spend a lot of time. We spend an equal amount of time doing quantitative analysis and qualitative analysis. Ultimately, it's a lot of meetings in person, reference calls, speaking to other investors, looking at doing primary research ourselves, getting comfortable with the opportunity, looking at how we think it will fit into the overall portfolio, which I'll spend a lot of time doing. And then, ultimately, it's my team coming to me with full recommendations for investment.
If you looked out 5 or 10 years, do you think the nature of endowment offices is going to change in any drastic way?
Yeah, so I've been in this space for almost 20 years, and I think it's one of those things where if I look back over 20 years, a lot has changed. And on the day-to-day, it doesn't seem like it's changing as much as it is. So I think today we are a lot more granular in the research that we're doing on the underlying holdings of the investments that we make.
What does that mean? Can you give an example?
Yeah, so we'll spend time researching the companies that our managers invest in and forming an opinion on that, whereas 20 years ago, it was hard to get some firms to even tell you what they owned.
On your behalf?
On your behalf. So again, when I started in Brown's investment office, it was pretty standard practice for a lot of hedge fund managers to say, well, we don't disclose what our holdings are. And I think there's been a real evolution, probably accelerated by the GFC in 2008 and 2009, of saying, well, that's not good enough. And I would characterize it as in a simple way of saying, people will frequently refer to what we do as being allocators. And I think we should think of ourselves as investors and owners, right? So there's been a shift in thinking to say, okay, well, you may make the investment decisions for UCLA, on behalf of UCLA, Mr. Manager, but ultimately we're responsible and the fiduciaries for that capital, and we have a right to know what it is that we're invested in through and through. And so the push towards transparency has been important, but that transparency is only useful if you can make informed decisions about what you think about value. And so I'd say some of the evolution I've seen in the investment professionals within this space has been a little bit more experience on the primary investment side, but deciding that they just sort of like, you can call it the forest for the trees type approach. Like, we're sitting on top of so many different asset classes and so many different, we get to speak to a lot of people who just have very specific knowledge on a very narrow set. That may not appeal to, look, it doesn't appeal to me. I'm interested in all the different asset classes, so.
Let's talk specifically about your role as the CIO of a large endowment. What is it right now that you are spending your own time on, thinking about on behalf of your senior team? terms of industry or in terms of changes or in terms of technology changing the decision making you make?
Yeah.
What do you read books on, spend your time going to conferences on, as opposed to your team?
Sure. So the things that I spend the most time thinking about today would be kind of and it sounds sort of obvious, but the rate and valuation environment, liquidity, which we've talked a little bit about, and then, I think for us, we don't do a lot of real thematic investing, but because we're trying to make secular decisions, and so making a 1 or 2 year decision is not the kind of thing we want to look at.
What do you mean by secular and thematic?
Yeah, so I'd say, we wouldn't, if there was a big dislocation in, let's say, chemicals, we wouldn't rush out and say, we need to find a chemicals manager, we need to invest. Right. But we would say, for me, a thematic investment might be healthcare and biotechnology, where, 3 or 4 years ago, we looked at, a confluence of massive increases in compute power. And I think AI is an area that's probably, it's a hot topic, but I don't think is maybe appreciated as much as what it can do in the healthcare space, as maybe people are looking at things like ChatGPT. But if you think about being able to simulate various, trials, and things like that, I think that area is really interesting. So we looked at it and said, okay, well, there's massive changes in, again, computing that doesn't seem to have a direct impact to healthcare, but there's that. You had lowering costs of things like sequencing genomes, so you had, an interesting component there. You obviously have an aging society here that we talk about, and 20% of U.S. GDP. So there's going to be a lot of dollars spent there. So there should be opportunities. But you also had, in Asia, both increasing wealth as well as, frankly, whole new populations coming into to trials and testing. And so we looked at that and said, okay, well, there should be a lot to do in a space like that. That's thematic, but it's a decade plus view. So that's the kind of thing that I might spend some time thinking about and then say to our team, hey, we think we should be just keeping our eyes open for opportunities here, from real estate all the way through to venture capital.
Do you think your style is different from the standard style of people who run endowments? And if it's different, how? That's a great question.
Thank you. Part of me wants to say yes, part of me wants to say no. I have a feeling some people would say yes, in that I think we do put a lot of emphasis on finding the right partners and the right motivated people, and are willing to turn down opportunities that maybe, well, this is a high returning, this is this, for, I think we have a reputation for pushing back and negotiating on the university's behalf that I'm not sure some of my peers are always willing to do with GPs.
And you lose deals that way, no?
Sometimes, but not always. I mean, I think we have a reputation of being an honest and straightforward investor and giving open feedback to people on what. I think that's the thing that I would stress more than anything else. I know this is, I have very good friends of mine who are on the sales side who, get no response back or get wishy-washy responses on no's. And we say no 99% of the time. Everyone wants not just UCLA's money, but in my seat, everyone wants UCLA's money.
Yeah.
And so we say no a lot. And so trying to figure out and let people know why we're saying no, it does take a little bit more time, and providing that constructive feedback. But I think a lot of that's just I see a lot of people who just don't provide that.
Let me ask one last question and then suggest that any of you who may have questions get prepared to ask Justin. I've heard you talk about AI, health, biotech. There's a lot of people both sitting here and probably listening or watching on Zoom who are either changing careers or entering a new career. I'm always thinking about different career situations for friends and mentees. Those three industries, are those three high growth industries that you would recommend people keep their eye on? And are there any others that they should be thinking about, that you're thinking about as an investor?
Okay. So I think it will seem sort of consensus, but yes, certainly I think the what we talked about in terms of healthcare, anything that is data oriented or data rich appears to be a growing area. I think, if I were to take something that's maybe a little bit off topic that might give let's say maybe not quite a contrarian
Go ahead, provoke a thought.
Angle on that would be, what does all of this need? All of this needs power and infrastructure. And all of those are capital intensive businesses that the last 10 or 15 years, investors haven't been interested in. And investors want capital light businesses, capital light business models. Very high returns on capital because there's no capital. What that means is you can justify a really high multiple if you think that that's a sustainable kind of long-term business, but there's really no terminal value to those businesses. So you really have to judge how long, what the duration is of that business, but there are no assets there. So, power plants, anything that's energy transition, that might seem, quote unquote dirtier, probably have longer lives than you're thinking about from a career standpoint. So I think that's maybe something that's somewhat contrarian that's still going to feed into this need and hunger for data. So, those that are paying close attention to what the hyperscalers are doing, hyperscalers being Microsoft, Alphabet, Amazon, Facebook, in terms of growing data, they're some of the biggest consumers of not just electricity, but water. Yeah. So, figuring out some of those things I think are really interesting and probably not where the majority of people are focusing.
Thank you. Anybody have any questions that they want to ask Justin?
So you mentioned that standard deviation is something that you really think about. 8% equity returns and a standard deviation of 15-20%. But you also mentioned that you have a time horizon of 100 years. So how do you sort of reconcile that?
Yeah. So, and thank you for asking, because it's probably a little bit more granular. And Craig's seen this chart a few times. I'll give you a real live example, a real life example of it. So if you go back over the last 23 years, so think of what we're trying to do. Take $1 million gift. and put it in the S&P 500, which over that time period hasn't done 8, it's done 7, okay? And pay out 5% every year, okay? Then take the endowed pool, which has underperformed the S&P 500, okay? I think we've done 6% over that 23-year period, and pay out 5% every year. Which do you think is paid out more?
S&P?
No, it's about a 20% higher payout from the endowed pool. And that's because of the volatility. It's the path that matters when you're paying money out. I'll give you something that's even more stark. Don't make it a 5% payout. Start at a $50,000 payout and grow it in real terms, okay? If you invest in purely stocks at that volatility level, you ran out of money in 2016.
Right.
So that's that volatility drag is real. So it doesn't matter if you have no cash flows in the interim, it doesn't matter. Yeah, you're bigger.
Right.
But you actually have obligations in payment to make. And that's why even though you have this perpetual horizon and you can take more risk, the volatility of it really does matter.
And this is a great example of endowments versus your personal investing or somebody else investing. That's a good example. Did you have a follow-up or you're good?
That's a great question.
Thank you so much.
Thank you. Thanks for
question.
asking.
Yes.
I have a personal interest in venture capital, so I was curious to hear about your sentiment towards venture capital, given the current, economic or global climate.
Yeah.
You had mentioned the allocation is about 8%. I wonder, kind of following your investment thesis, if you see that growing over the next couple of years.
Yeah.
And then my follow-up to that is about, as a fund of funds, how you think about evaluating managers in that area and what niches of what sector you'd like to see them investing in.
Excellent.
Question.
Okay, so to give some context, when I took over as CIO, UCLA's venture allocation was about 2 or 3%.
Oh.
And we'll get into it, but for a variety of reasons, between 2007 and 2014, UCLA had made 0 commitments to venture investments. I'd like us to be around 12% long-term as a kind of a target asset allocation to venture. Venture is, if you look, again, coming to that question around, let's call it annualized returns over a long period of time, highest returning asset class. So why wouldn't you want all of your money there? It's also one of the more cyclical asset classes, even in private markets. So there are 10-year periods, which look, it's a blink of an eye for a university, but it's still material if you're living through 10 years where the return for venture capital can be negative. And that doesn't work when you're having to pay money out. So as much as you might want exposure to these dynamic businesses that can be, generate multiples of capital, there's a limit to how much I think is prudent. And one of the concerns maybe at the moment in the venture space is you may not see distributions and you may have inflated values in investments today, and that shapes how you can invest over the next 4 or 5 years if you don't have the capital available to deploy. Our focus is primarily within our asset allocation for venture capital to be investing in seed and Series A, or pre-seed, seed, and maybe Series A, smaller funds is the idea, because the rest of our portfolio has, some other types of exposure. So we're looking for diversification there. Whereas I think today, a lot of people who may have even had that, we're fortunate, in terms of where we sit today. If you had that approach over the last 10 years, the bulk of your NAV, your net asset value of your venture portfolio, may have started as seed businesses, but it's sitting today in probably Series D, E, F, and is probably overvalued. Certainly relative to where public markets had moved, and so that becomes a challenge. But fortunately we don't have that issue. It's typically going to be smaller fund sizes. I think one of the challenges that people really want to think through when you're looking at what you expect from outcomes is your ownership level in some of these venture companies is really important. And so if you have, let's say, let's just use two very simple figures. Let's say you have a $100 million fund and you have a $1 billion fund. The number of $1 billion outcomes that you need to return the fund at certain ownership levels just becomes harder and harder as your fund size gets bigger. So, a lot of the seed funds, you're looking at ownership levels, ideally fully diluted, you're getting maybe 10%. So now you only need kind of, $1 billion outcome. $1 billion fund, you're probably getting down to 1% ownership to really move, so it just becomes a hard math problem.
My question had to do more with benchmarking. So how do you really benchmark the investment company? Is it just, the goal is to just meet this sort of stated return on the IPS? Are you benchmarking against other endowments? How do you what does success look like for you?
You love picking on the things that this is another one of my little pet peeves. I always say, benchmarking and evaluation in this industry goes from the sublime to the ridiculous. And so let's say what should it be? So it should be your objective. You need to do 5 real. So that actually should be your primary. So that's at the top. Okay, how do you get there? That then probably becomes your asset allocation and taking some proxy for what that represents to say do we think this is going to get us to 5%? And are we getting there within each of these asset classes? So that might be public markets in the public space, private markets, and others. So you're creating a portfolio benchmark, which we have. And ideally that portfolio benchmark should be sort of achieving your objective. Then you can have questions within that around, do you want to do something that is investable and replicable, or do you want it to just be what the asset classes do? So that's where you could say you could have it all public, you could have some of it private. Okay, those are probably the two that I think make the most sense. Then you start moving into, well, what's everyone else doing? We'll use my alma mater, Princeton, as an example. So the CIO from there has just retired after 30 years. Okay, and the institution is over 250 years old. So it's in just a very different place than UCLA is at an investment office that's 10 years old. In terms of, if we're talking to the gentleman over here's question around venture capital, that's the longest lived asset class. Those are investments where you don't know whether they've been successful or not. And sorry, I didn't get to that question, to answer that question, for 7 or 8 years. So it appears it's helpful to know because they're all really, really smart people at all of these institutions, and you want to know what they're doing. But comparing them on a quarterly basis, I don't think it's as helpful as people made up. But everyone does it. When I say it's sublime to ridiculous, you still have to deal with it. And then finally, the last one is always whatever has been the best performing asset class over the last 10 years. So, it's made more hard when it's the S&P 500. And everyone's like, well, you can't beat the S&P. It's like, well, that's really not your objective. If your objective was to beat the S&P, or in 2008, a lot of everyone wanted to be invested in emerging markets debt. I was like, well, EM debt is what we should all do. So,
I'm curious about knowing, how do you manage and mitigate the underlying fees, as you mentioned, SFF model? So how do you manage and mitigate the underlying fees against the cost efficiency, and also selecting the funds basically against their quality and the returns?
Yeah. So A few things in there to maybe to some of the conversation Craig and I were just having here. When you say, do you lose deals? I was like, well, sometimes, yeah, it becomes a fee negotiation where we don't think that that's an appropriate fee level for what you're delivering. We are happy to pay fees if we think it's something that is differentiated that, justifies the cost of what is being done. And we're also very happy to pay performance fees. So in a lot of instances, especially in the stock side of things, we have 0% management fee structures with our managers where they're, if they generate returns above some kind of a hurdle, then they participate very well. Or they can choose just a flat fee. So there is a lot of discussion on that front, and we spend a lot of time just trying to kind of evaluate what we think. But yeah, part of it is, what do you think the underlying rate of return is for this asset class? What can you get in a low-cost structure, and comparing it on a relative term? That's kind of the way we look at it.
My question is pretty basic. So it's very easy to find out spot opportunities in the market sometimes, but it is tougher to exit. Considering your horizon level is perpetuity, more than 100 years per se. So how do you decide when to exit? And also considering that you're an endowment fund, that also means that you need to play a little safe. So considering that geopolitical tensions like wars take place, US is close to the debt ceiling and that talk keeps happening. So how do you guys decide when to pull out?
I think this is one of the hard, right? Selling is one of the hardest things to do. Ideally, what you're looking for is fundamental change. To fully exit a relationship and a manager, it's a change from what you originally underwrote. So there are countless examples and academic studies on people, and everyone is guilty of doing it, making decisions based on trailing performance, right? And I would be lying to you if I said we weren't influenced by that. We are. Everyone is. But ultimately, what we try and do, we write an investment memo for every decision we make, particularly when we start a relationship, but when we exit a relationship, we also write an investment memo. And it's what are some of the things that you identify as core risks, and what are the things that you're expecting. So the easiest reasons for us to exit, even if they're hard to do, it might be a really good performing manager, but they may have grown too large in size for what we think their addressable space is. They may have grown too large in size in terms of just team members, where we aren't convinced that the founder and the portfolio manager is as close to the investments as they used to be. They might have introduced more products. Those are, there are often life cycles to firms. Yep. These are very much people-driven institutions, and we are underwriting people ultimately. So that's coming back to my comment about trying to be a psychologist as well. Those are the things that really we ideally should be looking for. Now, on trimming decisions, it might be valuation based. It might be, hey, has this manager rallied 70%? That's an unlikely rate of return going forward. Those are harder decisions because, if it's coming off of a very low base, there might be a long way to go still. So, that's kind of where you're looking at the underlying valuations. But yeah, it's a very difficult decision. But those are the things that typically result in us passing on a new fund or exiting a manager. Changes in the firm.
Fair enough. Thank you so much.
Thank you. Let me ask a 30-second question, or 30 seconds for your answer, because I know a lot of people are always thinking, what's your opinion of the U.S. economy for the next year or so?
I would say I was...
You can dodge the question if you want.
No, look, I was shocked at the strength of the economy over the last year. If you had told me 3 years ago interest rates are going to go from, on the short end, from 0 to 5.25%, I would have said there's going to be a lot of pain.
Yeah.
I still kind of am surprised at the strength of it. So would I be shocked at a recession? No. But I'd also equally not. I mean, it's been surprising how strong the U.S. economy has been. So I don't see I can tell you, I don't see a reason for the Fed to cut rates if the economy remains strong. We could say like, well, they should, but why? For what reason? So.
Right. Well, thank you to Justin. It's rare, I think, to get somebody who will be as blunt and somebody who is in a position that affects all of us who care deeply about UCLA. And my final comments are, a little bit of a pitch to you. I know all of you are in the midst of careers or career change or full-time here, but once you're in a position to give, we need to grow that endowment. So I hope I know many of you are not undergraduates, and quite often we have this deep loyalty to our undergraduate institution. But as you plot your future, I hope you'll be reminded of what you're getting from the #1 public university in America. So thank you again, and I think that will conclude everything. There's Lucy.